Okay, so we've talked about the business cycle with the ups and the downs and expansions and contractions or recessions. And we've talked about one way to fix the economy through fiscal policy. In this lesson, we're going to talk about how to fix the economy through monetary policy. Okay, so as I said in the last video, we talked about fiscal policy, which we know is handled through Congress and the president. And in this video, we're going to talk about monetary policy, which is handled through the Fed and the banks. Monetary policy deals with interest rates. So, how much interest are you being charged on a loan, for example, or how much interest you are earning off your investments, for example, like a savings account or CD. Okay, so interest rates, bank reserves. Now, bank reserves are the amount of money that the bank has to keep on hand, like keep at the bank. Now, hopefully you understand that we deposit money into the banks, and banks loan a portion of that money out to other individuals and businesses and charge them interest so that when they pay it back, the bank is making money and they can pay the investors, like us who deposit our money into the bank, they can pay us a small portion of interest as a reward for banking with them. So, how much money the bank is loaning out depends on how high the bank reserve is. So the Fed is going to set the bank reserve level, and that determines how much money the bank has to keep on reserve and on hand, which limits how much it can loan out. So the banks cannot loan out a high amount of money if bank reserve requirement is high. If the bank reserve requirement is low, then they can loan out more money. So the Fed is going to control that in efforts to help stabilize the economy. Monetary policy also deals with the amount of money printed and coined, and we'll talk about that. The United States has the Bureau of Printing and Engraving. And that is where money, like dollar bills, are printed. The mint is going to coin money. Our coins in our currency, like nickels and dimes, is coming out of the mint, and then our paper money is coming from the Bureau of Printing and Engraving. Okay, so how much is being printed and created is determined by the Fed. All right, so what is the Fed? This isn't like, oh, the Fed's after me. Not like that, okay? The Fed is short for the Federal Reserve System, okay? Oftentimes we refer to the Fed as one thing, but it is really a leading bank, a central bank, and a system of banks underneath of it, okay? So the Fed is the bank's bank and the government's bank. So let's talk about this part first. The bank's bank. What do I mean by that? It's where banks get their money after the mint and after the Bureau of Printing and Engraving issues it, okay? So the government's going to create the money and they're going to distribute it through the Fed. All right, so the headquarters for the Fed are in Washington, D.C., and I'll show you a picture of what that looks like in a minute. But then there are 12 different districts of the Fed. So there's a Richmond district, a Richmond branch of the Fed, an Atlanta branch of the Fed. There's a Dallas branch of the Fed. You get the idea. So each of these, so think about your bank, okay, in little old North Carolina. It's going to get its money from the Richmond headquarters. Richmond is going to get it from the D.C. headquarters of the Fed. Okay, if you live in somewhere in California, then the Fed is distributing money to the San Francisco branch of the Fed, and then San Francisco is distributing that money out to its banks underneath of it. So it's a whole system, and that's how money is distributed. That's how when you deposit your raggedy old $1 bill you've had like in your pocket for the last 3 years and it's fallen apart, when you deposit it into the bank and you take it out later, you have a crisp $1 bill. How do you have a crisp $1 bill? Well, that's because that money is being retired, your dollar bill that's raggedy, and replaced with a crisp $1 bill. Okay, so government's bank, what do I mean by that? So we know what the bank's bank means. How is the Fed the government's bank? It's like the government's checking account, really, and where the savings bonds are issued. So later in this course, we'll learn about investments, and one way you can invest is through U.S. savings bonds. And if you are doing that, that money is coming from the government's bank. It's being issued. A check is being written from the Fed. Now, the government's checking account. Okay, have you ever thought about like where does the stimulus money come from? Where do unemployment benefits come from? Where is the money for like Veterans Affairs coming from? Well, it's all being like we pay taxes, and that those taxes are deposited somewhere, right? That money has to be housed somewhere. It's not like it's sitting in the White House or sitting in the Capitol building for Congress. It is deposited into the Fed, and then the Fed is going to issue that out in efforts with the U.S. Treasury. All right, so here's what the Fed looks like. It's not really something we're just going to break into in Washington, D.C. And you can see this if you ever go to D.C., you can see it. Okay, so the Fed has been given 2 tasks through law, through Congress. So those 2 tasks are to maintain price stability and to achieve maximum employment. Okay, we know that full employment is not possible. We cannot have 0% unemployment in the United States. It just is very unlikely because, one, we have minimum wage, and we learned in our lessons on supply and demand and shortages and surplus, when you start adding price floors and price ceilings, eventually you won't have full employment. And so we compensate that through paying out unemployment, and the government has a goal of maintaining, like, for example, 5% unemployment. Any higher than that is too high, and the Fed is going to need to adjust using its tools to lower unemployment. All right, now when I say price stability, really what we're referring to here is inflation. We know that over time there will be inflation. It's just the fact of the matter. The goal, though, is not to keep inflation from happening too quickly. So everyone's heard of, like, your grandparents saying, oh, back in my day, gas cost $0.25, or I could get a soda pop from the machine for 10 cents or a nickel. And now we know that, if you're getting a drink from a drink machine, it's probably going to be over $1. Why is it that it used to be so cheap and now it's more expensive? That's due to inflation. So inflation is when your $1 will get you a certain amount of goods, but later that $1 cannot purchase the same goods because the price of those goods have gone up. And I'll insert an infographic into our PlayPosit video for those of you who are watching through PlayPosit. So you can see a great infographic that explains how this works. And I'll attach it to my YouTube video too in the comments. All right, so the goal for the Federal Reserve is to keep inflation from getting too crazy, right, to maintain price stability, and to achieve maximum employment. All right, so they're going to do 2 things. Just like we talked about with fiscal policy, we have loose policy and we have tight policy. And if the economy is not doing well, we are going to have a loose policy. The Fed is going to want to encourage people to be loose with their money, to spend their money, because when the economy is not doing well, people do not want to spend their money, and therefore the Fed is going to want to encourage people to spend money to help us get out of the recession. So back to our 3 tools that the Fed can use. They can create more money and put it into circulation. If there's more money supply in the economy, think about the circular flow, then more people are going to be spending money, and that will help get us out of the recession. They will also lower interest rates. If they lower interest rates, think about it. If it used to be a 10% interest in order to take out a mortgage, and now it's a 3% interest to take out a mortgage, you're much more likely to take out a mortgage and buy a home. Because if you only had to pay back 3% more, or 3% in addition to what the loan is for, versus having to pay back 10% plus what the interest is for. So think about $100,000. If you're buying a $100,000 house with a 3% interest, then you're paying only 3% of $100,000 over time as you are paying back your loan. If you're paying back 10%, that's a much higher amount. So lowering interest encourages people to take out loans. It also doesn't give them as much incentive to save the money. If I'm getting less interest on my investment, I'm more likely just to go spend it elsewhere. I'm only getting 0.5% interest on my account that I'm investing in. Why even bother saving it? I'm only getting 0.5%. But if I'm getting, 25% interest back on my investment, that's a really high amount. You better be saving some money if you're getting 25% interest back. That's pretty good. So lowering the interest rate encourages people to save money, and lowering the reserve requirements. Remember, the bank reserve requirements is how much money the bank has to keep on reserve. They cannot loan out. So if you are lowering the reserve requirements, that means the bank can loan out more money. And we want people to take out loans. For one, there's low interest. And two, if they're taking out loans, they're going to go buy things like a car, for example, or a house. And as people, or a boat, people take out loans, they're going to spend the money. You don't take out a loan to put it in your savings account. You take out a loan to go buy something, to buy a car or buy a house or a boat or an RV or something. So when the banks are loaning out money, we want that to happen during a recession, okay? Because that puts more money into circulation, and it leads to people spending more money. So if the economy is not doing well, stay calm and spend money. That's what we want people to do, because that's what gets our economy growing again. On the flip side, if the economy is doing well, if we're going up in expansion, okay, we want to tighten up a little bit so that we do not expand too quickly. If we expand too quickly, then we will bust faster, and then we'll have a recession. So the Federal Reserve is going to institute a tight monetary policy if the economy is doing well. And to do that, here are their three tools again. There's going to be less money in circulation. They're not going to be printing or coining as much money and putting it into circulation. We're going to be a little tighter with our money, so we're not just putting it all out there so quickly, because if there's less money, less people are spending it. Okay? They're also going to raise interest rates. If you raise interest rates, this does two things. One, it discourages people from taking out loans. Okay? If it's, 20% interest rate on buying a house, no thank you. People don't want to do that. They're going to want to buy homes when the interest rate is very low. So the lower the interest rate, the more likely it is to take out loans. Also, if you raise interest rates, back to what I was saying earlier, if I'm getting 25% on my investment, I am going to invest. That's a really good return rate, right? So interest rates on your investments are high. People are going to, instead of spending that money, they're going to be pocketing it or saving it and putting it into investments, not circulating it through the economy. Also, if banks have a high reserve requirement, that means they cannot loan out as much money. And if they're not loaning out as much money, people are not spending said loans. Okay? So a tight policy is going to slow the economy by taking less money out and discouraging people from spending money. We don't want to discourage them from spending money altogether. We just don't want them to spend it all right now. We want to slow down that process, right? All right, so take a moment to practice these. Decide if the action is going to slow or speed the economy. And I will throw the answers up in Play Pause It if you're watching through there, and on my YouTube video if you're watching there.